December 31st, 2025. As the ball dropped in Times Square and the world welcomed the new year with optimism, a silent emergency was unfolding inside the Federal Reserve of New York. While the public celebrated, a historic and terrifying figure was flashing across the screens of the central bank's trading desk: $74.6 billion. That is the exact amount of cash Wall Street banks frantically borrowed from the Fed's standing repo facility in a single 24-hour window. To the untrained eye, this is just a number, but to anyone paying attention to the mechanics of power, this is a siren. This was not a routine year-end adjustment. It was the largest liquidity injection in the history of the facility, a massive, desperate bid for cash that the mainstream media completely ignored. The official narrative is that the economy is booming under the incoming administration. You are told that the banking system is resilient, that inflation is tamed, and that the bull market is invincible. But the balance sheet of the Federal Reserve tells the truth that the news cycle hides. If the system were truly healthy, banks wouldn't need a nearly $75 billion lifeline just to survive the night. While you were told to watch the S&P 500 hit new highs, the real smart money, the institutional architects of the market, were fleeing the private sector and running to the Fed for protection. They know something you don't. This is not a glitch. This is the precursor to the 2026 pivot. The bond market is signaling a seizure. Donald Trump's economic roadmap for 2026 demands cheap debt and aggressive growth. But the plumbing of the U.S. Treasury market is clogged. The private sector refused to lend, forcing the state to step in. What happened on New Year's Eve was a warning shot fired directly at the heart of the American financial system. The dashboard is blinking red. History is brutally consistent on this pattern. When the repo market breaks, the real crash follows exactly 6 to 12 months later. We are now on the clock. To understand why the Federal Reserve had to emergency print nearly $75 billion on New Year's Eve, you first have to understand the invisible architecture of the battlefield. Most people look at the stock market, the S&P 500, the Dow Jones, and think that is the economy. It is not. The stock market is just the showroom. The real engine, the plumbing that keeps the entire global financial system alive, is the repo market. This is where banks, hedge funds, and the government lend and borrow cash overnight, backed by U.S. Treasuries. It is the oil in the engine, and in the final days of 2025, that oil began to dry up. The catalyst was a mechanism known in the halls of Wall Street as year-end window dressing. Every year, as the calendar turns from December 31st to January 1st, the world's largest banks, the GSIBs or global systemically important banks, must take a snapshot of their balance sheets. This snapshot determines the capital surcharges they have to pay to regulators for the coming year. It is a regulatory game of hide and seek. To minimize these fees, the biggest banks in America, J.P. Morgan, Bank of America, Citi, effectively go on strike. They stop lending, they hoard cash, they shrink their balance sheets to look smaller and safer than they actually are. They retreat from the repo market, refusing to lend cash to other participants just so they can report a cleaner number to the government. This is a known phenomenon. But in 2025, it revealed a terrifying fragility in the private market. When the big banks stepped back, there was no one left to take their place. The liquidity evaporated instantly. The private funding market, which is supposed to be robust and deep, turned into a ghost town. The price of money immediately exposed the scarcity. The cost to borrow cash overnight, the repo rate, spiked to 4.70%. For the average person, 4.70% sounds like a meaningless number. But in the world of central banking, this is a tremor. It was significantly higher than the Federal Reserve's target range. It signaled a disconnect between the Fed's fantasy and the market's reality. The Fed sets the price of money, but on December 31st, the market rebelled. The banks were saying, "We don't care what the Fed says the rate should be. If you want cash today, you are going to bleed for it." But here is where the story turns from a technical issue into a systemic absurdity. While banks were desperate for cash, screaming for liquidity and driving rates up, there was simultaneously a massive ocean of money sitting completely idle elsewhere in the system. At the exact same moment the repo market was seizing up, money market funds and other entities had parked a staggering $434 billion in the Fed's reverse repo facility. Think about the insanity of this design. On one side of the street, you have $434 billion doing absolutely nothing, earning risk-free interest from the Fed. On the other side of the street, you have banks and dealers starving for capital, forced to pay penalty rates just to survive the night. This bifurcation is not an accident, it is a feature of a broken system. For the skeptics watching this, understand what this means. The financial system is not efficient. It is rigged by regulation. The capital exists, but it is trapped behind regulatory walls that benefit the safety of the money market funds while leaving the banking sector vulnerable to sudden cardiac arrests. The free market was not allowed to allocate that capital. The plumbing was clogged by the very rules designed to make it safe. This brings us to the ghost of September 2019. 6 years ago, we saw this exact scenario play out, but with catastrophic results. In September 2019, corporate tax payments and treasury settlements drained cash from the system. The big banks stopped lending. The repo rate didn't just tick up, it exploded to 10% intraday. The financial system nearly froze. It forced the Federal Reserve to intervene with emergency measures that eventually mutated into the massive money printing of 2020. The events of December 31st, 2025 are the historical echo of that crisis. The difference this time is that the Federal Reserve was terrified. They saw the repo rate climbing to 4.70%. They saw the private market abandoning the field. They knew that if they didn't act immediately, 4.70% could become 10% again. They knew that a repo spike in 2026, under a new administration promising economic expansion, would be a political disaster. So they didn't wait for the crash, they preempted it. But do not mistake this intervention for safety. When a patient requires life support just to survive a calendar change, they are not healthy. They are terminal. The spike in repo rates and the retreat of the big banks is the canary in the coal mine. It proves that the U.S. financial system cannot function on its own without the constant, heavy-handed life support of the central bank. The private market is too weak, too regulated, and too fearful to handle the flow of American debt on its own. And as we are about to see, the specific way the Fed intervened reveals an even darker truth about the quality of the assets rotting on Wall Street's balance sheets. Now, we need to perform a forensic autopsy on that $74.6 billion figure. To the casual observer, money is just money. But in the shadow banking system, not all dollars are created equal, and not all debts are the same. When we peel back the layers of the December 31st transaction log, the aggregate number is shocking, but the composition of the collateral is the smoking gun. Banks did not just walk up to the Federal Reserve and ask for a handout based on good faith. They had to pawn assets to get that cash. They had to hand over collateral. And this is where the story shifts from a liquidity problem to a solvency warning. The $74.6 billion borrowed was split into two distinct categories. The first tranche was $31.5 billion secured by U.S. Treasuries. This is standard operating procedure. Treasuries are the gold standard of collateral, pristine, liquid, and safe. But the second tranche is the anomaly. The remaining $43.1 billion was secured by mortgage-backed securities. Let that sink in. On the biggest borrowing night of the year, Wall Street banks handed over significantly more housing debt to the Fed than government debt. This is a massive red flag. In a healthy market, mortgage-backed securities are traded easily between private banks. They are supposed to be liquid. The fact that primary dealers had to dump over $43 billion worth of real estate paper onto the Fed's balance sheet tells us one thing clearly. The private market did not want it. When the pressure was on and cash was king, other lenders looked at that housing debt and said no. They refused to finance it at reasonable rates. The banks were stuck with billions in a liquid housing paper that became toxic the moment liquidity tightened. This imbalance suggests that the banking sector is currently stuffed to the gills with real estate debt that is far harder to move than they admit. It indicates that the smart money in the private repo market is becoming allergic to housing risk. If the banks are using the Fed to warehouse their mortgage exposure on New Year's Eve 2025, what does that tell you about their confidence in the real estate market for 2026? They are bracing for impact. This brings us to the mechanism itself, the standing repo facility. You can think of the SRF as the pawnbroker of last resort. It was created specifically after the disaster of 2019 to ensure that no matter how bad things got, there would always be a window open where banks could exchange bonds for cash. For years, the Fed has insisted that this facility was just a failsafe. It was a fire extinguisher behind glass, meant to be looked at, not used. The narrative was simple. We built a safety net, hoping never to use it. On December 31st, that net caught a whale. You have to understand the psychology of Wall Street to grasp the gravity of this. Banks hate using the Fed's facilities. It carries a heavy stigma. In the clubby world of high finance, tapping the Fed for cash is like admitting you can't pay your bar tab. It signals weakness. It signals that your counterparties don't trust you enough to lend to you. Banks will pay a premium to borrow privately just to avoid the shame of going to the Fed. The fact that they swallowed their pride and borrowed a record $74.6 billion proves that the private door was slammed shut. They didn't go to the Fed because they wanted to. They went because they had no choice. The stigma was outweighed by the desperation. So who benefited from this bailout in disguise? The beneficiaries were the primary dealers, the Wall Street giants that serve as the interface between the Fed and the market. These are the institutions that lecture the average American on the importance of free markets and risk management. Yet, on the final day of the year, they utilize the public balance sheet to clean up their own mess. By swapping their illiquid mortgage-backed securities for Fed cash, they effectively window-dressed their risk profile. For 24 hours, they got to pretend those heavy bags of real estate debt were liquid cash. They transferred the risk of that collateral to the public ledger for the night, crossed the finish line into 2026 looking clean for the regulators, and then unwound the trade when the sun came up. The system is beautifully designed for them. It allows the elite institutions to privatize their profits from mortgage lending during the year and then socialize the liquidity risk of those same mortgages on New Year's Eve. They use the Fed as a laundry machine for their balance sheets, but while they washed their books, they revealed the stain. The banking system is choking on real estate debt, and the only buyer of last resort is the one with a money printer. We have established the crime scene and identified the weapon. Now we must understand the motive and the mechanic. Why does this technical malfunction in the repo market matter to the future of the American presidency? To answer that, we have to look at the collision course between the political agenda of 2026 and the mathematical reality of the Federal Reserve. The political landscape is clear. The administration driving the Trump plan for 2026 has staked its reputation on a resurgence of American growth. The roadmap is aggressive: deregulation, potential tax incentives, and industrial expansion. It is a vision that requires fuel. In the modern economy, fuel means credit, and credit means debt. To fund this vision without raising taxes, the U.S. Treasury must issue massive amounts of government bonds. They need to sell debt to the world to pay for the growth at home. But here lies the conflict that the events of December 31 exposed. The market has just proven that it is struggling to digest the current level of debt, let alone a massive new wave. When banks borrow nearly $75 billion from the Fed overnight, they are screaming that their balance sheets are full. They cannot absorb any more treasuries. The plumbing is clogged. If the Treasury tries to shove trillions of dollars of new debt into a system that is already choking, simple supply and demand dictates what happens next. Bond prices collapse and yields skyrocket. This is the nightmare scenario for the White House. If the 10-year Treasury yield spikes, driven by a lack of buyers, it acts like a wrecking ball. It drives up mortgage rates, crushing the housing market. It drives up corporate borrowing costs, killing business expansion. And most dangerously, it explodes the interest expense on the national debt, eating up the very budget the government is trying to spend. This is where the Federal Reserve enters the room, not as a savior, but as a co-conspirator in a covert operation. The Fed knows that the private market cannot handle the supply of debt coming down the pipeline. They saw the cracks on New Year's Eve, so they have engaged in a strategy of quiet QE. They will never call it quantitative easing again. That term is politically toxic. It reminds voters of inflation and money printing. Instead, they use sanitized technical language. They call it balance sheet management. They call it ensuring ample reserves. They call it the standing repo facility. But look at the mechanics, not the marketing. When the Fed allows banks to swap $31.5 billion of treasuries for cash on a moment's notice, they are artificially creating demand for government debt. They are telling the market, buy the bonds. If you get stuck with them, we will bail you out. By buying short-dated bills and keeping the repo window wide open, the Fed is secretly greasing the wheels of the Treasury market. They are injecting liquidity to artificially suppress bond yields. They are the invisible hand holding the interest rate down, creating the illusion of a stable, hungry market for U.S. debt when, in reality, the natural buyers have left the building. They don't call it printing money anymore. But when you create cash to absorb debt that the private sector rejects, the effect is exactly the same. This creates a dangerous illusion for the average investor. You look at the 10-year yield and think it reflects the economy's health. It does not. It reflects the Fed's level of manipulation. This leads us to the ultimate power dynamic of 2026, the bond vigilantes. For the intellectual curious watching this, you know the old Wall Street maxim: the president proposes, but the bond market disposes. Right now, the Fed is the only thing standing between the administration's economic plan and the wrath of the bond market. If the Fed decides to step back, if they decide that inflation is a bigger threat than a liquidity crunch, and they close the spigot, the protection vanishes. Without the Fed's artificial suppression, the liquidity crunch we saw on December 31st would turn into a yield shock. Rates would scream higher. The housing market, already sitting on those billions of illiquid MBS we discussed, would fracture. The power dynamic is stark. Donald Trump may sit in the Oval Office, but the person who controls the repo lever at the New York Fed controls the fate of his presidency. It is a Faustian bargain. The administration gets its cheap debt and its stock market highs, but only as long as the Fed agrees to keep expanding its role as the market maker of last resort. The moment that support wavers, the math takes over. And as we look toward the horizon of 2026, the math is starting to look ugly. The mechanism is straining, the engine is overheating, and the warning light that flashed on New Year's Eve was just the beginning. So, where do we go from here? If you turn on the financial news right now, you will hear a very specific, coordinated message. The talking heads, the bank lobbyists, and the government spokespeople are all singing from the same hymn sheet. They will tell you that the events of December 31 were a nothing burger. They will call it a technical adjustment. They will use soothing phrases like seasonal friction or temporary dislocation. Their job is to keep you calm, to keep you invested, and to keep the capital flowing into the stock market casino. Do not believe them. We need to dismantle this narrative with cold logic. A healthy, robust financial system does not require $74.6 billion in emergency funds just to survive a calendar turn. A confident market does not see its biggest players fleeing to the Fed for safety in the middle of a bull run. When a healthy person goes for a routine checkup, they don't get rushed to the emergency room for a blood transfusion. The fact that the banking system needed this transfusion proves that the patient is sick. The technical adjustment excuse is a lie designed to mask the severity of the condition, and this condition is about to get much worse. We are approaching what macroeconomists call the liquidity cliff. Remember the $434 billion sitting in the reverse repo facility that we discussed earlier? That money has acted as a buffer for the last few years. It has been a massive reserve tank of excess liquidity that the system could draw on when things got tight. It was the shock absorber that smoothed out the bumps. But that tank is leaking. It is draining rapidly. Current projections show that the RRP facility will likely drain to zero sometime in 2026. The buffer is evaporating. This is the doom scenario that the crisis anticipators have been fearing. December 31st was a stress test while we still had some cushion. The system passed, but the engine overheated. In 2026, we are driving into a desert, and we are doing it without a spare tire. When that RRP balance hits zero, the next liquidity crunch won't just be a spike in rates, it will be a hard stop. There will be no excess cash to cushion the blow. When the banks run out of reserves next time, there is no backup tank. The volatility will not be contained. It will spill over instantly into the stock market, the gold market, and your 401k. The 2026 crash will not look like 2008, where bad mortgages blew up the banks. It will look like a market seizure, where the pipes simply stop flowing. The bid-ask spreads will widen, trading will halt, and liquidity, the ability to turn your assets into cash, will vanish. So, for the self-educated investor, the question is no longer, what stocks should I buy? The question is, how do I survive the freeze? You need to understand a fundamental truth that Wall Street hides from you. Cash is not trash, but liquidity is king. However, liquidity does not mean money in a bank account. In a systemic liquidity crisis, your bank deposit is a liability of the bank. It is an IOU. If the bank cannot access the repo market to fund its operations, it has every legal right to limit your access to that money. We saw it in Cyprus, we saw it in Lebanon, and we saw glimpses of it during the regional bank failures of 2023. When the doors close, they close fast. This brings us to the ultimate protection strategy. To survive a liquidity freeze, you must hold assets that exist outside the banking ledger. This is the historical case for gold. Gold is the only financial asset that is not someone else's liability. It has no counterparty risk. When the repo market freezes and the digital banking network goes dark, gold remains liquid. It is the ultimate insurance policy against a broken financial plumbing system. And for the modern era, this is the intellectual argument for Bitcoin. Forget the price action for a moment. Forget the moon memes. Look at it structurally. Bitcoin is a bearer asset. It does not rely on the Fed's repo window to settle. It does not need a G-SIB bank to approve the transaction. It is a parallel liquidity network that operates 24/7, 365, regardless of whether Wall Street is having a seizure. The strategy for 2026 is not about getting rich quick. It is about sovereignty. When the banks close the doors, you need assets that don't rely on their permission. The event on December 31st was the final warning. The system is blinking red. The elites have already made their move. They used the Fed to secure their liquidity. Now the window is open for you to secure yours, but that window is closing. As we move deeper into 2026 and the liquidity tide goes out, we will see exactly who is prepared and who was listening to the technical adjustment narrative. Don't let your financial future depend on a system that needs a $75 billion bailout just to survive New Year's Eve. The record borrowing of December 31st, 2025 was not an accident. It was a revelation. It stripped away the marketing veneer of Wall Street and showed us the rotting beams underneath. The banking system is far more leveraged, far more fragile, and far more dependent on state support than any regulator will ever admit on camera. The Trump plan for a new golden age of prosperity is being built on a foundation of cracking ice. The contrast is now undeniable. They tell you the economy is booming. They point to the S&P 500. But behind closed doors, the architects of this system are borrowing billions of dollars just to keep the lights on overnight. The liquidity tide is going out, and we are about to see who is swimming naked. The crisis of 2026 won't start with a bang. It won't start with a headline you see on CNN. It started with a silent wire transfer on New Year's Eve while the world was distracted by fireworks. The signal has been sent. The clock has started. You have been warned.